The market is currently closed, and the last reported closing price for Rezolve AI PLC, trading under the ticker RZLV, was $2.72 on December 2, 2025, at 4 p.m. Eastern Time, reflecting the significant drop that followed the major news event of the day before. The stock hit a low of $2.72 and a high of $2.96 during that session, on heavy volume of 16.7 million shares, which is right in line with the heightened activity this name has seen recently. Now, the common expectation narrative here, especially in the wake of such a sharp decline, is that this is simply a deeply troubled microcap name, a small technology player that got ahead of itself, and now the market is correcting for its ambitious, high-risk moves. The consensus among many retail investors and quick-take commentators is that the company took on a substantial financial burden, and the market is punishing the lack of fiscal prudence. The immediate reality, however, is a fascinating and counterintuitive one. The massive share price contraction is not just a simplistic panic over debt, but rather a complex, almost premeditated reaction to a major strategic acquisition that fundamentally changes the company's business profile and valuation model, the Crownpeak deal. This move, which was seen as a clear negative by the immediate trading action, is actually the single most important long-term catalyst and risk factor pivot the company has seen since its public listing. What the general market seemed to miss in the rush to sell off is the underlying strategic rationale that goes far beyond a simple P&L line item. Management, led by CEO Daniel Wagner, who has a history with the acquired asset, is effectively exchanging short-term financial discomfort, the substantial assumption of approximately $150 million in debt and the $90 million initial purchase price for Crownpeak, for a massive, immediate injection of tangible revenue and a proven blue-chip client roster. The acquisition is projected to bring in $70 million in annual revenue and is expected to be immediately accretive to EBITDA. Now, for a company with Rezolve's previous revenue profile, a $70 million revenue jump is not incremental, it's transformative. The tension here lies precisely in the fact that the street's expectation was focused on the dollar sign of the debt, while the reality is that the management is prioritizing scale and established customer relationships, a key factor for any enterprise software provider, over maintaining a pristine, debt-free balance sheet in the short term. This move signals a definitive shift from a pre-revenue, AI-focused promise to a legitimate, scaled software enterprise, and that transition comes with its own inevitable growing pains that manifest as steep stock declines. Looking at the recent stock movement confirms this dynamic. The stock price has fallen approximately 36% over the last month, and over 25% in the last 3 months leading up to the news. This is not a sudden crash, it's an accelerating decline, one that suggested the market had already priced in significant financial weakness and perhaps skepticism about the company's ability to execute its original plan. When the Crownpeak deal was announced, the reaction was swift and negative, dropping the share price dramatically. The high daily volume on the day of the decline strongly indicates institutional flight or a massive unwinding of positions, specifically by funds that are structurally prohibited from holding highly volatile or financially leveraged microcap assets. The large volume on that day was likely forced selling, which always exaggerates price movement beyond fair value. The low liquidity and inherent volatility of a stock at this price level, paired with the significant news event that alters the risk matrix, creates a perfect storm for outsized negative performance. The question for sophisticated investors isn't why the stock fell, but when the market will re-rate the new entity based on the combined financials and, crucially, the newly acquired high-margin, sticky revenue stream. The core business of Rezolve AI has historically centered on providing what they term brain commerce solutions, essentially using sophisticated generative AI to power conversational commerce and frictionless checkouts for the retail and e-commerce sectors. Their initial pitch was a pure-play AI technology layer designed to sit on top of existing platforms, offering customer support, product discovery, and simplified buying experiences. Partnerships with major entities like Microsoft and Google lent an air of technological credibility, feeding the positive side of the market's expectation. However, the commercial reality, as reflected in the pre-acquisition financial reports, showed a company struggling to convert technical promise into large-scale, consistent sales, typical of many early-stage AI firms. The company's quarterly profit and loss statements from earlier this year consistently reflected massive net income losses and negative operating income, underlining a severe cash burn rate. The acquisition of CrownPeak fundamentally alters this. CrownPeak is a digital experience platform, a content management system designed for enterprise clients, and it possesses the stable revenue and established client base that Rezolve sorely lacked. The strategy now pivots to using Rezolve's proprietary AI suite to upsell and enhance the CrownPeak platform for its existing major brand customers, creating a much more defensible and sticky offering. This is an integration challenge, certainly, but it's a strategy built on the foundation of established customer accounts, not just future hypotheticals. Now, let's address the elephant in the room that is increasingly relevant for volatile names like Rezolve, short-selling activity. Rezolve AI has been and remains a clear target for short sellers. The classic short thesis writes itself: a high-burn, loss-making, micro-cap technology company that attempts to scale by taking on significant debt. It's the perfect setup for a fundamental short based on valuation and capital structure risk. While the exact, up-to-the-minute short interest figures are often delayed, the rising borrow rates and general chatter across trading forums like Reddit and certain ex-Twitter accounts strongly suggest that the cost to borrow shares has been spiking. Spiking borrow costs are the clearest, most immediate signal of high short demand and low share availability. This pressure is compounded by failed-to-deliver data, which, when high, indicates difficulty in settling trades, often exacerbated by aggressive shorting. Some major firms known for targeting high-growth, low-profit tech have been rumored in the trading community to be building large short positions, motivated by the belief that the stock's valuation, even post-drop, does not justify the negative book value and the current cash burn. The acquisition, with its massive debt assumption, gave the short thesis a shot of adrenaline, hence the pronounced drop. The narrative for the short sellers is that the company is simply papering over fundamental weakness with a leveraged buyout. For the retail investor, this is where actionable insights on short-selling awareness become vital. First, you must seek out verified short interest data, typically reported twice a month, and look at the days-to-cover metric. A high days to cover, anything significantly above 5, suggests that it would take many days of average trading volume for the shorts to buy back their borrowed shares, making the stock more susceptible to a sharp short squeeze if a strong positive catalyst emerges. Second, monitor the option's open interest. A disproportionately high number of out-of-the-money call options, or what is colloquially referred to as a gamma ramp,
can indicate coordinated buying that puts pressure on market makers and can accelerate a rally. Third, watch for institutional filings like F-13s. If a prominent long-only institution were to file a significant new stake in RZLV in the next quarter, it would provide a powerful counterpoint to the short thesis. The key takeaway is to remain analytical and responsible. Short squeezes are not reliable investment strategies, but the degree of short pressure is a key piece of information about the market's collective skepticism. It reinforces the expectation versus reality dynamic. The short expectation is failure and collapse. The long reality is that the new, larger, revenue-backed entity provides a floor and a mechanism for a genuine, fundamentals-driven rebound.